This next problem that we're going to do is based on the same company, Healthy Foods Limited, and we're still talking about the same products, the breakfast shakes. So here you will see the same information that we used when we completed our variable costing income statements for January and February. So now what we're going to do is basically use the same information to calculate what the absorption costing income statements would be. So as you'll recall, when we went through the variable costing income statement, the variable cost only included, as the name implies, variable manufacturing expenses. It did not include fixed. So for variable costing, you'll recall that was $5 for each shake, and that would apply to both January and February. However, for absorption costing, you still have the $5 for each month, but you also have to include your fixed cost expressed on a per unit basis. So the fixed manufacturing cost is $1,000, and we divide that by the number of shakes produced. So that would be 2,200. So it's not the number sold, but it's the number produced, which would give you 45 cents per shake if you had to take your fixed expenses and divide it across the number of shakes that you made. So we'll enter in our 0.45 here. So under absorption costing, the total manufacturing cost per shake for January is $5.45. So now we'll do the same thing for February. Again, we've got $1,000 of fixed expenses. Now in February, you only produced 1,800 shakes. So this will be divided by 1,800, which will give us 56 cents per shake. So as you can see, the fixed costs don't change, but if you try to assign fixed cost to the number of units that you make, the fixed price per unit will actually increase or decrease depending if you make more or fewer products. So now that we have our unit price, we will insert it up here under absorption. And so for February, the cost per shake is $5.56. Okay, so now that we have calculated our absorption cost on a per unit basis, we can now go ahead and complete our income statement. So the first thing, of course, is the revenue. And again, we're using the same data. 1,600 units were sold, and the selling price is $10 per unit. The next thing we have to calculate is our cost of goods sold. So in January, there's no beginning inventory. If there is beginning inventory, you would be told. In this situation, there is none. So there's no beginning inventory. Now we want to look at what is the cost of the goods that we actually made or manufactured in the year. So we're told that we produced 2,200 units. So when we use the term produced, we're talking about it can be used interchangeably with produced, made, manufactured, completed. All those terms can be used interchangeably. So what we made or manufactured in the year was 2,200 units, and we've just calculated our cost per unit on an absorption costing basis, which means we're including both variable and fixed costs. So that was $5.45. So that gives us the goods available for sale of $11,990. The next step is we want to subtract the goods that we had in stock at the end of the year. So basically, we manufactured 2,200 units, but we only sold 1,600. So as you can see here, that leaves us with 600 finished products in inventory that were not sold at the end of the year. So we need to subtract those. So it's 600, and the price is of course $5.45. So we have to subtract our $32.70 from the $11,990, which gives you your cost of goods sold of $8,720. This is subtracted from the 1600. So this gives you your cost of goods, your gross profit of 7,280. So sales of 16,000 less your cost of goods sold of 8,720 will leave you with a gross profit of 7,280. Of course, we're not done yet. We have our marketing and administration expenses, and here, as you will recall, we are told, and we'll just go back up here to look at the given information. So we are told that our marketing and administration for both years is $500. But in addition to that cost, we also have a sales commission of $1 per unit. So both the sales commission and the marketing and administration costs have to be deducted from gross profit in order to arrive at operating income. So now we enter in our operating expenses. So operating is marketing and administration and includes your selling commissions. So we know it's $1 per unit. So we sold 1,600 units. And then we have our fixed amount of $500. So that's $2,100 in operating expenses, which is subtracted from your 7,280 to give you an operating income of 5,180. So now we'll do the same transactions for the month of February. And the month of February follows the exact same process, except for the fact that in February you actually will start the period with some finished goods, some inventory that we had left that we hadn't sold. So basically the 600 here that we hadn't sold at the end of January, so they are brought into February. That's basically the only difference between the two income statements. So we'll start off with our sales revenue. So for February, we're told that we sold 2,000 units and the selling price remains the same at $10. Then we calculate our cost of goods sold. So we have our beginning inventory of 600, and this is multiplied by our, this time our absorption cost of goods manufactured into for the month of February was a little bit higher. As you'll recall, it was 556. Then our cost of goods manufactured, so we're told that we made 1,800 units and the cost of the 1,800 units was 556. So that should be 1,800 units. I had an extra zero in there. So that brings us down to a total of goods available for sale of 13,344. The final step in calculating your cost of goods sold is to subtract your ending inventory. So here you start with your beginning. The units you produce, the 1,800, gives you a total of 2,400 units available. We know we sold 2,000, so subtract your 2,000. It means you had at the end of February 400 units that were not sold. And they're valued at $556. And of course that is subtracted from your goods available for sale. This now becomes your cost of goods sold. So for the 2,000 units that you sold, it cost the company $11,120 to make those items. So this will leave you with a gross profit of $8,880. So now the next thing we want to do is subtract our marketing and admin expenses. So that will be our 2,000 units, and the sales commission is $1. And in addition, we have 500 of fixed expenses that we were given. So we end with $6,340 $380 worth of operating income at the end of February. So in both situations, you are accounting for both your variable and fixed costs, but you're doing it slightly differently in absorption versus variable. So the way it works, as you can see here, is with variable costing, your price of the cost of the goods that you manufactured only includes the variable overhead, whereas under absorption, it includes both fixed and variable. So that concludes this example of absorption costing.